Back. We are in J.P.Morgan India conference, and with me is Rajiv Batra, who is the Managing Director, Head of Asia, and Co-Head of Global Emerging Markets. Rajiv, thank you very much for joining us on ET Now. Uh, you know, flows have been determined by momentum, and we can't see that in India. So, where do you see momentum coming back in India?
Definitely, it should arrive. We have seen in the past that earnings momentum has been one of the best performing style or a factor for India, and then it culminates into price momentum also happening through. The sad story for India has been last 5 quarters, earnings have been quite anemic overall. If we look at the PEG ratio for India, it is coming close to at around 5x to 6x. For being a better valued market, it's not just the forward P. Investor wants sustainable growth with a PEG of around 2.1, 2.2. For that, we need a double-digit growth. And that means we need to start seeing downgrades should stop, upgrades should increase, and earnings revision ratio starts getting better. So a month or two, if earnings momentum comes, price momentum follows it.
So, do you think the GST cut or the indirect tax cut which has happened and which is effective now is going to get that momentum and mojo back to the earnings?
Definitely. Theoretically, yes. And we have never seen this economic logic have been defied unless the corporates and countries going for balance sheet recession. That's not the case India is in right now. So when you are seeing monetary policy easing, income tax rate cut, GST cut, you can't defy the economic logic that you are moving from a vicious cycle to a virtuous cycle. Where things will improve.
You know, when you look at foreign flows, the global funds are not coming to India, or they're on a wait and watch mode. Yep. You have the regional flows which are there, which is moving into emerging markets, or Asian countries like Korea or China, or for that matter Japan. They're moving into that. Do you think that all can reverse and come back in a big way into the moment into India if we are able to demonstrate that this consumption story is back?
No, so definitely if there's a rising tide, it is going to lift all the boat. But in case of emerging market, the false impression is that the rally this year has been premised on foreign investor. In real terms, if you will look at China rally, Korea rally, Taiwan rally, it has come on the back of local investments over there. When I look at the total emerging market net flows this year, number is still negative, -5 to -6. And if you dissect this number, 38 billion is the subscription from ETF, but 45 to 44 billion is redemption from my active guys. So it's a musical chair which is going on. But if we have a plethora of flows coming both the side, active as well as passive over there, it will start coming into India also. Remember, India even today is the second largest market in awaiting terms in MSCI EM after China.
That's true. But our weightage have fallen off as well because of the kind of correction that has happened. And as you said, the earnings have been muted, and despite the fact that the valuation has remained relatively higher, we have the premium of India to the Asian players have come down a bit. Isn't that enough for foreign investors to come back to India, or they really need something concrete on? And what are the triggers that you look at when you say that, okay, I want something which is a momentum piece here?
No, so India has never have been a valuation market. India perennially has been a growth market. Investor comes to India as a growth tourist. Like whenever you get the premium growth, you will invest in that destination. If that premium growth goes away, you will never come, because US can provide you plethora of it. And that is the reason why these are the two countries always trades at around more than 20 PE range.
Yes.
Why? Because they are known for sustainable growth. That's a separate story that US provides you not just the organic growth, they provide you growth in form of buybacks and dividends also as such. But in case of an India, it's a pure growth straight away coming from there, and that double-digit handle went to a single-digit 4% odd. So if that makes a comeback over here, people will not care about valuation. People will say, okay, my PEG ratio is 2.1, 2.2 or 2.5, which means your P can even command 25 mark if you are delivering me 10, 11 or 12% kind of an earning growth. So the question stops over there as such, but valuation also could become a criteria where I will not be surprised that if there's a thaw in relationship between US and India, then India can easily re-rate again back to 24, 25 PE. The reason I'm saying so in a very, like in a sane manner over here, because this is what I've seen in other emerging market. It is false to say that emerging market has rallied this year because of earning growth. Because when we did dissection of returns this year, 70% of return has just come in form of PE re-rating. currency appreciation, and then 15 to 20% by dividends, buyback, and only 10% of that whole component, which is 2.5%, is earning growth. Some of my economies in Latin America are delivering negative earning growth, but they have rallied because of their PE rating. India didn't got that advantage because people are worried about the risk in the US, and it's fair to say whatever is happening on the tariff front and this one, it is purely in the price because we have not seen any re-rating over here. And besides this growth and tariff, India needs to continue the new age reforms they have started. We already have seen that under Prime Minister Narendra Modi government, they have launched 3 arrows over here.
Yeah.
We saw monetary policy easing, number one. We then saw tax rate cut. Third arrow was your GST.
Yeah.
Now market is looking for the fourth arrow.
Which is that?
That will be your deregulation. Ease of doing business, ease of coming into the market as registering as an FPI or even as an FDI. As you start deregulating much more, market will give you more risk, more valuation over there, or further re-rating from current level.
You spoke about the fact that our markets have underperformed other emerging markets and Asian other peers, whether it's East European peers or Latin American peers, which is there, despite the fact that the earnings growth are much better than theirs actually. But from a street point of view, what kind of earnings growth are we looking at? I mean, even at this point in time, we are talking about 8 to 10% of earnings growth for the index, and that also seems much more lower for many investors. But if you compare it to your peers, it's much better there.
Definitely, but point is they are trading at the started point valuation was a single digit or a low double digit P. We started at a year at around 22p. 22. And a year back it was 24. In fact, we have de-rated.
21 now.
We are at a 21 right now at this juncture. So what market demand for us, give us a low teen or a mid-teen earning growth. That will be visible, but it will be second half of this fiscal year story. We anticipated at start of this year that the first half you need to go through some silent period. There will be inflection point where you will get 8 to 9% growth, which handle came in the last quarter that got reported.
Yeah.
But now as you move to December quarter, our anticipation is December quarter will give you 11 and March quarter next year will give you around 13. So your double digit handle will be the second half fiscal year story. But remember, market is always forward-looking animal.
And we are already, discounting 27 actually now.
Yes, yes.
So, do you think that you'll have this teen growth coming in 27, and market will start discounting that from maybe the end of the year?
Chances are bright. We know this year nominal growth, which is being the tracking for your revenue overall, it is coming at range of around 8.89% over there. But the chances are pretty high that you go again back to double-digit nominal GDP growth next year. And if that being the case, yeah, with cost of production, borrowing, raw material cost all getting down, yeah, we can assume a 14 to 15% territory at least of earning growth could be the case for FY27. Although I will say this time consensus or the sell side analysts are a bit cautious and forecasts are not that high. The kind of a cuts they have to do throughout this year, their starting point is 13.5 when I look at the consensus forecast. So I may see some bit amount of an earnings upward revision looking at the festive sales and sales beyond the festive, because that's the key question we are facing. That Rajiv, we hear you that this 1 month, 2 months, India will have a great consumption. But what after that?
Exactly. So, do you think that it's going to be a sustainable consumption going forward?
I think GST cut is not a one-off event. It is here to stay. It is not going to mean revert. We have seen in the past GST tax rate moving from 14.4 to 11. 11 moved from now to 8.5, 9 per se. Mean reversions have not happened over here. And you are just at a cusp of a start of this kind of an easing coming through. When in 2022 mid, India went to twin policy tightening, nobody questioned how lower earning growth will go. At similar situation when twin policy easings are happening, nobody is even thinking what amount of a growth we are going to get because of this kind of an easing coming through. And remember, as you go into next year, you need to prepare for 8th pay commission. You got 60 basis point of a GDP benefit from GST, 40 basis point of GDP benefit from tax rate cut. When 8th pay commission happen, maybe you get 1.5% of GDP benefit because of 8th pay commission.
So what's preventing people from investing and consuming in this market. Is there a sentiment boost which is there? Do you think that India-US tariff relations, if it gets sorted out, it changes entire dynamics with respect to the kind of mood which is there, the confidence which is there, and the spending power and consumption?
No, spending power, there was a question mark on the rural side, which is not totally went away over the last 1 year. We saw good monsoons.
But urban is still...
Urban was still reeling under pressure. Then remember, urban has been under pressure for the longest time. The pressure got off during the COVID time, where suddenly people were not moving higher, excess saving was their place, and that excess saving translated into consumption during 2020, 2021, 2022. But prior to that also, since the tax have been too significantly higher, both direct and indirect, where 55-60% of your salary just going and paying off two kind of a taxes per se, that burden government is lowering right now. That means more money is going to be in hand of my consumer. And again, you have an option. Either you consume, you deleverage yourself, or invest. And the change which we have seen not only in India, but across emerging market, there is now consumption of more assets rather than the actual goods and the produce over there.
Are you looking at, or are you seeing rotation of sectors also happening because of this, flows coming in? We saw initially financials were under pressure because there were some outflows which are going out. IT, is still an underweight for many, and I think for you as well, it's underweight, which is there. Now, with consumption and GC coming in, do you see that autos and consumer staples, all these companies are going to be re-rated in some way as soon as you see the trigger, on-ground trigger of sales coming in?
So diversification and rotation has been the theme, not just in India, but across emerging market as well as in Asia this year. At one quarter, we were seeing DeepSeek doing well. Next, we have seen Korea doing well. Then we saw Taiwan doing well. Then we, 2-month period, saw even India doing well as such. Something similar has happened in India also. Looking after the Prime Minister's speech after Independence Day, we saw a really good amount of a rally in the consumer staple space. And that showed up in the performances of the portfolio as well as allocations for us too. But as I've said in like few minutes back, when you are saving money, you will chase your aspiration. You will go for discretionary spending, which you and your family is postponing for the longest period of time. That means either you will increase your insurance premium, or you are going to go for buying two-wheelers, four-wheelers, consumer durables. So the discretionary spending will be the key over here, number one. And along with that, the derivative of that is the consumer loan, consumer financing. Like when you go across buying any white goods, for first 6 months, they are not charging you any interest rate per se. So that means it's one way to enter into that scheme and increase the leverage also in the system. So that also get benefit. So it's a kind of a cycle, as I mentioned. It's a virtuous cycle you are now getting into. That consumption is kick-starting for you. And maybe in 18 to 24 months' time, because consumption has gone higher, utilization levels have increased further, you may see the next step, that is private investment coming in place, private capex coming in place, which is an invisible man in India for the last 10 years.